Make this post real quick, guys, and we'll get started. Make this post real quick. All right, all right. All right, guys, so we're live. All right, we'll let everybody join. When they join, they can watch a recording. We're gonna record this and talk about it. All right. So a lot of people coming on Instagram Live, Facebook Live, more or less to I want to say bring fear, but a lot of them are bringing fear. All right. So what I want to do is, as I always do, I try to educate. So I want to educate everybody. All right. Bring down the fear that lets you know the real. All right. And then, give you some tips and tricks on how to ensure that something like this does not affect you going forward. All right. So we're going to talk about a few things here. All right. Number one, we're going to talk about what actually happens. All right. Most only really know about one bank failure. All right. Most don't know that there's been 3 in a matter of 4 days. All right. So on March the 8th, all right, Silvergate was the first bank that failed. Then on March 10th, the bank everyone else heard about, Silicon Valley Bank, they collapsed and failed. And then 2 days later, on March the 12th, all right, you had Signature Bank. All right. Today is the 14th. All right. So literally in the last 6 days, we've had 3 bank failures in 6 days. All right. So that's the facts. All right. Those are the facts. All right. Now let's talk about why each individual bank failed. All right. First of all, so before we get there, I just want to give another statistic, another fact. Both Silicon Valley Bank and Signature Bank were the second and third largest bank failures in U.S. history, behind Washington Mutual back in 2008 when we had the Great Recession. All right. So these aren't small banks. These are pretty sizable banks, with hundreds of billions of dollars in assets. All right. I believe the second largest bank failure, which was would have been Silicon Valley, they had over 200 billion in assets. All right, 200 billion. Now, to kind of give you an idea of how they compare against the big boys, JP Morgan Chase actually has $3.3 trillion in assets. 200 billion, 3.3 trillion. It's about 16.5x bigger. All right, so they're big, but they're not too big to fail, which a JP Morgan Chase, a Bank of America, Wells Fargo, those top 10 banks that got bailed out back in 2008, they are too big to fail. All right. So let's get down to the skinny of why each bank failed. All right. How it affects you, if it does affect you at all. And then, of course, what you can do to prevent it, going forward. All right. We're not going to be on here long. Just going to get to it and get off. All right. So Silvergate. All right. So Silvergate, they failed due to losses that they took in their portfolio. All right. Silvergate was a specialty bank. All right. The majority of their customers were cryptocurrency companies or cryptocurrency companies or cryptocurrencies themselves. All right. So if you don't know, a lot of the actual cryptocurrencies, they're actually businesses themselves. All right. They do what? They have to have somewhere to put fiat, all right, money into. All right. But then also there are companies that work with these cryptocurrency companies. All right. And they were also part of Silvergate's bank. All right. So FTX. All right. Everybody knows about Sam Friedman. If you don't know, go take a look at it. Huge Ponzi scheme. Not even gonna get into details about him. All right. Over $8 billion lost in that scheme. All right. Caused for what? Crypto to take a big plunge. All right. But it also caused for what? A lot of those cryptocurrency, companies and related companies to start pulling their funds from this bank. All right. And this all happened back in 2022. All right, the end of 2022 last year, if you guys remember and recall that. All right, now fast forward to this year here. All right, Silvergate. All right, for those who don't know, when your money is in a bank, you see it in your app or online that is there. You can go and take withdrawals out. All right, but for those who don't know, banks are only required to have 10% of their liabilities in deposits, meaning that if all of us that are watching this live stream go deposit, let's say up to $1 million, all right, up to $1 million into the account, all right, then they're only required to keep 10%, $100,000 of our actual money, our deposits in the bank. The other 900,000, they can They can lend out, all right? They can lend out, or they can go and invest themselves into, the financial market. That's what banks do, all right? They're only required to have 10%, all right, of deposits, all right, checking and savings, versus their liabilities, and their liabilities being what they have lent out: credit cards, loans on businesses, loans on houses, cars, the money they put into the markets. All right. So what banks do to kind of safeguard that, all right, is they will go and take some of those deposits to do what? To go get bonds and treasury notes, things of that nature. All right. Long-term ones that allow them, pay them interest, but then also, because those are very safe and secure assets, they tend to go up or stay very stable. So if they put $1 billion into one, it may make a little money, or it stays pretty stable. All right. So that way they have They have some security against anything that may go on with the fluctuation in the markets. All right. So with Silvergate, they had a run on their bank. All right. Had a run on the bank when it came down to FTX. All right. Silvergate was very, I guess they had the majority of their portfolio was in mortgage-backed securities. If you don't know what that is, go look it up. It is what caused the Great Recession. All right. And then also bonds. All right. Once the collapse of FTX happened, all right, it caused a run on the bank. All right. A lot of those cryptocurrency companies were wanting to pull their money. They wouldn't have access to it because that bank specialized in in cryptocurrency companies. All right. And over 90% of their deposits were cryptocurrency related. All right. So when the run on the bank happened, because they are only required to have 10%, they did not have all the money to give their customers. All right. Silicon Valley Bank. All right. Another specialty bank, but they specialize in tech companies. So the majority of their customers are tech companies. All right. Very similar. Only required to have up to 10% or max 10%. I'm sorry, minimum 10%. They can have more, but minimum 10% of deposits versus liabilities. And what they did, as far as from a Silicon Valley Bank standpoint, the way they offset their risk is they did the exact same thing. They went and bought They went and bought treasury notes and bonds. All right. Now, if you guys have been watching or paying attention to the last 18 months or so, interest rates have been on the rise significantly. All right. When interest rates go on the rise, all right, these treasury bonds, treasury notes, they decline in value significantly. All right, based on the way the banking system works. All right, which means what? Which means if you put $1 billion in that and now interest rates are climbing, then the value goes down. So now you don't have that $1 billion of security in that treasury bond to actually cash in if you need to have money on hand to do give back to your customers if they're making withdrawals. All right. Now, because interest rates went up significantly, that means borrowing went up as well. So when these tech companies, as you guys know, and if you don't know, tech companies use the system. They are constantly using other people's money to do to do business. All right. For example, back in the day, Apple used to have over 90% of their money overseas. And instead of bringing it into the United States and taking a huge tax penalty, they actually went and got loans to pay their bills. They got loans to pay back when they did stock buybacks because it was cheaper to borrow money than it was to pay the taxes on the billions they had overseas. All right. That's what they do. That's the system. All right. Now, interest rates went up. Those treasury yields and bonds went down in value. There was a run on the bank because now these tech companies need to pull out more money to do to pay their everyday bills, payroll, this loan, that loan, whatever the case may be. And then guess what? You guessed it. Silvergate happened. Tech companies got scared, run on the bank. All right. And they did what? Pulled their deposits out. But there was what? There was not enough money. All right. To give back customers all their money. That's why they collapsed. All right. Signature Bank, who just failed 2 days ago. Very similar. They're a specialty bank as well in cryptocurrency. Same thing happened. All right. They collapsed due to mainly though, because of Silvergate that collapsed due to cryptocurrency. All right. But then also the snowball effect, when you add in what happened with FTX and Silvergate, that is what compounded to Silvergate falling. All right. So those are the reasons why all three banks collapsed. All right. Now, let's talk about the conclusion on why they collapsed. Number one is overexposure to a particular market. All right. Two of the banks were overexposed to cryptocurrency. All right. And one bank was overexposed to tech companies. All right. Number two, huge increase in interest rates. All right. These huge increase in interest rates declined their bank holdings. All right. Therefore, they could not do what? Safeguard their customers' deposits. All right. And be able to pay them out when they needed to. All right. Next is lack of sufficient deposits. They're only required to have a minimum of 10% versus liabilities. So if they have $1 million in liabilities, they're only required to have $100,000 in deposits. That's the way the system works. All right. That's the regulations and the rules. All right. I don't think it makes sense because if I want more money, I want more money. That's just what it is. But that's the system. And banks, because they get paid on taking risk by risking giving you loans, giving us loans. All right. Also making risk in the market. All right. That's how they make money. That's how they pay their bills. They pay their employees. But it can lead to what? Failures. All right. So lack of sufficient deposits, as banks are only required to have that 10%. All right. And then lastly, panic. So panic in the market. Customers panicking, trying to get their money out. All right. Those reasons right there are what led to the failure of those three banks. The last two banks didn't have to fail, but due to panic from the first bank, it snowballed. All right. So what has been done? We'll talk about what's been done, by the feds. Number one, all right, both Silicon and Signature Bank, so Silicon Valley Bank and Signature Bank, the last two that failed, the Fed stepped in and they're now going to guarantee all withdrawals. So they took over the banks and guaranteeing all withdrawals. If you guys didn't know, all right, there's what's called FDIC. So that's the Federal Reserve will insure your deposits. All right. So if you ever go and you see the FDIC at the bank that you bank at, that means that your money is insured by the government, the US government in your bank. All right. This has been in place since the Great Depression. All right. Back in 1929, when the Great Depression happened, to ensure what? Customers don't lose their money like they did back then. All right. Now, this insurance is only up to $250,000. So if collectively your account has more than 250 grand, you're not insured on anything above that 250. All right. So we'll talk more about that later. So that is what they did. They insured over the 250K. All right. To ensure that all the companies get their deposits. All right. For a couple of reasons. They did this to ensure that there isn't a mass hysteria with more and more banks failing. All right. They did this to ensure that the banking system doesn't falter again, because if that happens here, it happens around the world like it did back in 2008. And they ensure that the tech companies and crypto companies don't falter, because that causes what? Imbalance in the actual markets, which will cause turbulence, which will cause us to go the wrong way very, very fast. All right. So the last thing that the Federal Reserve did is they created what's called the Banking Term Funding Program. So it is an emergency loan program where the government will loan banks, money to ensure they have money and liquidity to give their customer their deposits, for 1 year. So 1 year loan, for all banks, or all institutions that accept deposits. You don't even have to be a bank to accept deposits. As long as your institution accepts deposits, you can actually apply for this loan if you have liquidity issues. All right. So that's what's been done. All right. That's what's been done. Now, how does this affect you? All right. And we're here at the end. All right. How does this affect you? Well, for most of us, out here, if you don't have $250,000 in your bank account or bank accounts, don't worry about it. Your money's insured. So a bank could fail, but you can still get access to your money. All right. It may be a process, maybe a little lengthy process to get your money, but rest assured your money is what is insured if you have less than 250,000. All right. For those who own a small business, large business, or just do very well for themselves when it comes to the job they have, and you have more than 250K, you're not insured beyond that. All right. So one thing you may want to do is diversify, place money in different institutions. All right. Your 250K is insured at this one bank. So if you have 400,000, you may want to split it up and have half and half. So half at one bank, half at another bank. I can tell you personally, I bank at 3 banks, and I keep everything separate. I've got my business is split between 2 banks. All right. I'm sorry, 3 banks. And then I personally bank at one of those 3 banks as well. So my business is insured on 3 different accounts or multiple accounts, and then 3 different banks. And then I'm insured personally at one different account, one bank, multiple accounts. So it doesn't matter how many accounts you have. They look at what accounts are actually in your name. So if you get 5 accounts at one bank, then that's what they insure is up to 250K for you underneath those 5 accounts that you have your name on. All right. That's why I separated mine. I got the businesses and I got multiple banks. All right. So that's one thing you might want to do is diversify. All right. But if you've got less than 250K, not much to worry about. The banks, the government has also bailed out the system. So there really is very little risk that can happen, especially with these big boys up here that have the trillions of dollars in assets. They're too big to fail, first of all. We found that out back in 2008. The government is not going to let them fail. All right. So if you have your money with the big banks, there's really nothing to worry about. So I've already been hearing and seeing stuff on Facebook and Instagram, people going to the bank, taking their money out. It's a waste of time. Don't do it. All right. Don't do it. Especially if you have less than 250K. Now, is it always good to have some cash on hand? Yes. But there's no reason to go clean your whole bank account out and make a panic. It's just not that big a deal. All right. Now, the only banks that may be still exposed are going to be your specialty banks and some of your smaller regional banks. But the big boys, like I said, too big to fail, not worried about it. All right. I can tell you all 3 of the banks that I bank with are all the too big to fail banks. All right. They may suck from a standpoint of customer service, and you may get better, promotions and treatment at some of these small regional banks. But these too big to fail banks are too big to fail for a reason. And therefore, you have a little better security there than you would in a smaller regional bank. All right. So what are some things that you can do? Like we talked about, you can diversify banks. All right. That's number 1. You can diversify assets. I can tell you right now, I've got money in the banks. I've got money in cryptocurrency. I've got money in precious metals. So I actually have, gold and silver bars and coins. And then also, later on this year, actually in the very near future, in the next 2-3 months, I will have assets in real estate, a few pieces of real estate. So I'm diversified, all right, in multiple areas where my wealth is at, all right, and trying to build my wealth up by making proper moves. I also have money in the foreign exchange markets. So my money's everywhere. So I don't have to worry about one area losing more than the other, because then I can always go to another area of where I have my assets at and actually leverage that to live off if I need to. All right. So that's one thing you can do as well. All right. Another thing you can do outside of that, if you're worried about a recession, a great recession, or whatever may be coming, all right, is make sure you have a side hustle or a business or trade. All right. Another stream of income. If you have not realized or woken up since the pandemic, it is almost entirely impossible to live off of just one income now. All right. The pandemic showed that for a lot of people, because guess what happened? Jobs disappeared like that. All right. I know people right now. I heard from somebody today, getting laid off. I heard somebody from yesterday getting laid off. I heard from somebody last week was already laid off and reached out to me, about investing. I hear about it every week. All right. Jobs have been disappearing for the last 6 months or so in a more upbeat pattern. All right. And it happens. It's a cycle we're in. All right. You need to be prepared. All right. If you're not prepared, then you are putting yourself in jeopardy. You need to be prepared. So it doesn't matter what you do, side hustle, a business, a trade, something that can offset if that, you lose your mainstream income. All right. Also make sure you have money saved up as well for a rainy day. All right. So just want to bring you guys this information. A lot of people out there trying to scare people into, for whatever reasons they have ulterior motives. I just want to put this out there and let you guys know what actually happened, all right, what the government did about it, and how it affects you, which for most of us doesn't really affect any of us in a major manner. And am I expert? Well, do I know everything? No. I mean, very well, next week, the bottom could fall out and we could go into total, recession again. All right. But as of right now, from what I can see, with the research that I've done and just what I know about the banking system, is more or less, like I said, enclosed to some of these smaller regional banks, specialty banks. All right. So the banking system seems pretty strong. Housing markets, we'll see how that goes. That definitely, has opportunity to tumble. But we've been in a recession for about a year, 8 to 9 months, somewhere in that range. And start to pick up steam. Everybody can see it. The cracks are there. All right. So be prepared, but no need to panic. All right. If you guys are gonna watch this on live stream, definitely leave a comment below. All right. I'm actually gonna take a look at the comments now. If you got a question, definitely drop it in the comment here on Facebook. I'll take a look at it and see if you actually have written anything. All right. But for the most part, that's all I got to say. So I'll take a look to see if anybody has anything here. We'll give it a second because I know there's a delay. All right. So if you got questions, definitely ask. But that's the skinny, guys. Like I said, just bring you information. That's it. Bring information. I will say starting next month, if not the end of this month, for those who remember, I used to do Money Talk Mondays. All right. I'm bringing that back. All right. So Money Talk Mondays, I'm bringing it back. We're going to educate the right way about money. All right. When it comes to making money, saving money, avoiding paying money, more money than you should, like with taxes, anything revolving around money, we're going to talk about. All right. It's all about education. So that's coming back. It will be on Mondays at 7 p.m. Central Standard Time. So we'll be doing that here pretty soon. All right. Let me check the chat right here. Let me check the chat. There's a lot of comments about thank you and whatnot. All right. Cool. So I'm not going to stay on here long. Been on here for about 30 minutes. All right, guys. So it's good to be back on Facebook Live. This will be recorded. I'll drop the link from our YouTube channel. And of course, if you're on Facebook, you can always check the past link. All right. See you guys in the funny papers.